Capital Asset Pricing Model, or CAPM.
The foundation for the capital asset pricing model was the work of Harry Markowitz. His work in portfolio choice was later expanded on and developed into a model by Traynor, Lintner, and Sharpe, who later won the Nobel Prize in economics. The model describes the expected return of a security as a function of the riskiness of the security. The underlying assumption of the model is that an investor should be compensated in two ways: the time value of money and the risk of investing in a security that is not sufficiently diversified so as to eliminate performance risk. For compensation, an investor should receive the risk-free rate, such as that which would be received with the purchase of a risk-free bond, plus a risk premium. The model looks like this.
This model shows that the return of the security is equal to the risk-free rate plus beta multiplied by the market rate of return minus the risk-free rate.
In this equation, R security is the return of a specific security. R free, or the risk-free rate, represents the time value of money. R market is the return of a highly diversified market. And beta is a parameter that expresses the volatility or relative movement of a specific security relative to the entire investment market. When you subtract the risk-free rate from the market return, you get the market risk premium. When you subtract the risk-free rate from the security return, you get the investor's risk premium. As you can see, beta represents the proportional relationship between the investor's risk premium and the market risk premium. The beta of a highly diversified market is equal to 1. As we learned with the previous examples, individual companies have their own different beta values. A value of beta greater than 1 indicates the security is more risky than the market as a whole. A value less than 1 indicates the security is less risky. The beta for a stock can usually be found on investment websites such as Yahoo Finance and MSN Money. It can also be obtained using a regression analysis.
Another component of the model is the risk-free rate. This is the rate of return an investor would expect to receive if they invested in a security with no market risk, such as a government bond. Typically, the rate of return for a 10-year government bond is yield. A difficulty with implementing the model is that the market return assumes inclusion of all possible investment opportunities. This includes securities, customer goods, art, real estate, and human capital, essentially anything that represents an investment. Since this is obviously not feasible to obtain this return, a relatively smaller, highly diversified portfolio such as the S&P 500 is typically substituted.
The purpose of the capital asset pricing model is to find what the rate of return should be for a security relative to its riskiness. Let's look at an example for one of my favorite companies. Let's calculate the expected risk-relative return for Starbucks on March 10, 2009. On this day, the yield for a 10-year bond was 2.98%. The beta for Starbucks was 0.76, and the S&P 500 closed up 6.37%. Using the capital asset pricing model, we can see that the daily return for Starbucks stock should have been around 5.5%. As you can see from this example, a stock with a beta less than 1 would not be expected to increase as much as the market increases. Let's look at another example using the same risk-free rate of 2.98% and market return rate of 6.37% as we used in the Starbucks calculation. Here, General Motors has a beta of 1.65. Even though the market only increased by a little over 6%, General Motors should have gone up by about 8.5% since its beta is greater than 1. The capital asset pricing model can also be used to evaluate the return of a portfolio of more than one stock. To do this, a composite beta must be calculated based on the proportion or weight of each stock within the portfolio. For example, if a portfolio was made up of 20% Starbucks stock with a beta of 0.76, 20% General Motors stock with a beta of 1.65, and 60% Walmart stock with a beta of 0.26, the composite beta would be calculated by multiplying the beta of each stock by its percentage and summing the results. The resulting portfolio would have a beta of 0.64. This means that by adding stocks with lower betas, you can offset or hedge the risk associated with stocks that have higher betas. Using the capital asset pricing model and assuming the same risk rate and market returns from the previous example, we can see that the return of the portfolio should be around 5.2%. This return is lower than the return of both the Starbucks and General Motors stocks by themselves. However, in the event of a general downward trend in the stock market, the loss of this portfolio would not be as great as that experienced by the individual stocks. This is the benefit of diversifying a portfolio with both high and low beta stocks.
As I said, diversification is an effective way to manage the risk in a portfolio, since the stocks with lower betas will offset those with higher betas.
Okay, so if the market return trends downward, the lower beta stocks will help to moderate the downward movement, and if the market return trends upward, the higher beta stocks will help to capture some of that upward movement, right?
Yes, that's right. If a portfolio is sufficiently diversified, you can reduce the risk of the portfolio to a level near the baseline market risk. In every investment market, there is an inherent risk level that cannot be diversified away. The more stocks you add to the portfolio, the closer you get to that baseline market risk. Here, let me show you.
As you can see in this graph, when you increase the number of stocks in your portfolio, you gradually decrease the risk because you are diversifying. Eventually, you get to this point when diversifying doesn't reduce the risk anymore. That's the same level of the market risk. Since the idea behind the CAPM model is to relate the expected value of one variable to a universal average through use of the proportional coefficient, this concept can be applied to other disciplines. For example, in structural engineering, the structural supports of a building must be designed to withstand the dead loads imposed by the building materials. The dead loads of each building element are calculated based on their volume or quantity and unit weights. But variations in material weights and construction methods may result in the actual dead loads experienced by the supports differing from those predicted through calculations. To account for this, the calculated dead loads are multiplied by a coefficient and the dead loads used in design are higher. This coefficient is called factor of safety. In this context, the factor of safety performs a similar role to the beta in the CAPM model since it represents uncertainty in the materials and construction methods. The concept can also be applied to insurance premium pricing. For example, with auto insurance pricing, there is an average premium that is based on the age and sex of an applicant. Since this is not sufficient information for an insurance company to accurately evaluate an individual and the financial risk they represent, the average premium can then be adjusted with a coefficient to determine the premium appropriate for the specific individual. This coefficient is based on information about the individual such as their previous driving record, vehicle type, and etc. In this context, the adjustment factor in the insurance premium model performs a similar role to the beta in the CAPM since the adjustment factor represents the risk associated with the insuring a specific individual.
The capital asset pricing model was an important step in the development of portfolio value modeling, and its use over 40 years after its publication still prevails, especially in business and financial economics. The concept behind the model, which is the relationship between a relatively more or less risky asset and a highly diversified market, can be applied to many other disciplines, as we showed with the structural design and insurance examples.
Typically, the rate of return for a 10-year government
pricing model is defined with the rate of
which is the relationship between relatively
Now we are finding expected return.